Imagine your client is running a growing business and they have just taken out a loan to finance a big opportunity. Maybe it is to purchase new equipment, expanding their business operation, or invest in a new product line. Being their financial advisor, it is obviously your responsibility to record this transaction appropriately by following all the principles of US GAAP. Now you are facing a challenge of recording it correctly on your financial statement, how you are going to calculate the interest expense of it, how you are going to split the payment between interest and principal portion by ensuring you are complying with all the rules and regulation of USDA. In this video, we are going to exactly understand the whole process, how you can easily classify this, the expense portion, how you can easily calculate this, how you can easily classify the principal portion of it. If you are not from finance background as well, you are going to learn this with the help of simplest example possible in this video. Now, I'm going to share my screen so that we can understand the concept in accounting for loan as per US GAAP. For this, we should be knowing about what is US GAAP, right? So, US GAAP, a GAAP is generally accepted accounting principle. It is a set of rules and standard that a company in United States must follow while preparing the financial statement. GAAP ensures that the financial statement are consistent, comparable, and transparent for investor, regulator, and other stakeholder. Now, while calculating this loan and while doing the accounting of this loan, we should be knowing about this key terms. First is loan principal, interest expense, and amortization. The original, what is loan principal? The original amount borrowed by the entity from the lender. What the amount what you have taken in loan, right? The interest, it is an expense, it is an cost to the company, what you are going to pay. What you are going to pay. Usually we are denoted in terms of percentage. Then amortization, the process of gradually paying off loan over time through the regular payment. The process of gradually paying off a loan over time through the regular payment. Now we have initial recognition of the loan. How we are going to record this loan initially in the books of account when we are taking the loan, how we are going to classify this initially. So initial recognition says that you have to record this in fair value. What is fair value? It is usually the amount what you have received. It is usually the amount what you have received. Let's suppose you have taken loan worth rupees $100,000. So what accounting entry you are going to pass is this: cash account debit by $100,000 and loan payable. This is your liability with the same amount. Now we are going to discuss about subsequent recognition. How we are going to record this subsequently. Okay. Subsequent recognition. In this, we have to see amortized cost. So after initial recognition, loan must be measured at the amortized cost. I'm going to discuss with the help of example as well. So amortized cost involve accounting for both principal repayment and the interest repayment. This includes principal repayment as well and interest repayment over the life of the loan. Now we have to use effective interest method for this. For this, I'm going to take one example. You can see this example. This is very basic example I'm going to take. Hope you are able to see my screen. Yes. Okay. So a company borrows $100,000 at an annual interest rate of 10%. So 10% is your interest rate and you have borrowed $100,000. So initially how you are going to record at this value only. Cash to loan liability. Okay. Now you are going to repay this in equal installment of 5 years, which is 60 months. What you will do is 5 years into 12. You are going to get 60 months. So each month you are going to pay some amount. How we are going to calculate the monthly payment amount? Because this amount includes principal portion as well as interest portion. So this is the formula. With the help of this, you can calculate. Now, this is your principal amount. This is rate of interest. Rate of interest is 10%. But what we are going to do, we are going to divide this because we want monthly interest as well, right? So 0.8333% usually we are going to pay monthly. Okay. Now, N is number of the month, which is 60. We have already calculated 5 years into 12, which is 60. Now I'm going to show you this is the monthly payment. What you will do is you have to calculate with the help of formula. Now after this, a company is going to make amortization schedule for whole 60 months from first month till 60 months when our loan amount is actually 0. Okay. So now let's discuss this amortization schedule. So beginning balance would be $100,000. Now the monthly payment, what we have already calculated earlier, the monthly payment is 2124, 2124.7. In this, we have two things, interest expense and principal payment. Now, how we are going to calculate the interest expense of it? I'll just show you with the help of example. So initial our balance was $100,000. What the rate of interest we have calculated for monthly rate of interest is 0.8333%. So you just have to multiply this $100,000 into 0.833%. You are going to get the interest amount for this month only. Okay. So 833.33. They're exactly the same. Now, for the second month, what you are going to do, see, you have paid this much amount. This is your monthly installment. Out of this, you have calculated this interest expense. This expense you are going to take in income statement, or in India, we call it as profit and loss statement. Now, out of this, this is your interest expense. Now, if you deduct this from this monthly payment, you will definitely get a principal portion of it. Now, how you are going to calculate the ending balance of it? How you are going to calculate the ending balance of it? For ending balance, what you have to do is you have to take the opening balance and you have to deduct the principal portion. You don't have to deduct the monthly payment. Okay, you have to deduct principal portion. You can see with the help of example, $100,000 and my principal is 1291.37. 1291.37. So this is my closing balance. In this balance, you are going to charge the interest for the second month. In this balance, you are going to apply the monthly rate and you are going to calculate the interest expense for that month. Okay, for second month, our opening balance is this, and in this, we are going to calculate the interest. The rate of interest is 0.833%, which is technically 822.57 amount. This we are going to take in profit and loss. Okay, now if you'll see, the interest expense is this and the principal, the monthly payment is this. So we can easily calculate the principal portion. If what you'll do is from opening balance, if you'll reduce this principal portion, then you are going to get closing balance. This you have to do for 60 months. This you have to do for 60 months. Then at the end of the 60 months, your loan amortization table shows is going to show you the loan balance of 0. Okay, you can easily see. Okay, at the end of the 60 month, at the end of the 5th year, our loan balance is actually 0. Now, how we are going to record this in the financial statement? What entry we are going to pass? First entry, when you are going to receive, we have already discussed this, cash you have received of $100,000 and the loan payable, which is $100,000 only. This is your liability. Now, every month, what entry you are going to pass? This interest expense. This expense you are going to take in profit and loss, income statement. Okay. And this loan payment you are going to take in liability. You are going to reduce in liability and cash goes out. So you are going to credit the cash account. I'll just repeat, this expense you are going to take in profit and loss or income statement. This loan payable you will reduce, because when you have taken the loan, you have done the credit effect of it. If you'll reverse this entry by this amount, so your loan balance will actually go down and you will pass this entry with the help of cash. I hope you have understood this simple example. With this, we have already seen how we are going to record the loan initially, how we are going to make amortization table, how we are going to record this loan. Subsequently, how we are going to bifurcate the principal portion of it and the interest portion of it. What entry we are going to pass. With this, thank you so much for connecting and happy learning.